Next, Amazon, 2 e-commerce stocks under $10. And let me shock you right at the start. One of them is a well-known online retailer trading under $10. And the other is a true penny stock trading under $2. You heard that right. Sub $2 for a company pulling in hundreds of millions in revenue. Stick with me because these aren't just names you scroll past. They're companies that could still surprise the market. Here's a wild fact. Amazon's IPO price in 1997 was just $18 a share. Adjusted for splits, that's about 75 cents. 75 cents to over $3,000 at its peak. Every investor dreams of catching the next story like that. But the reality is, those opportunities are usually buried in the low-price names everyone ignores. Today, we're digging into exactly that space. Now, before I jump into the details, I've got a quick ask. If you want me to keep hunting down hidden gems like these, smash that like button. Let's hit 500 likes on this video, because that tells me you want more deep dives into overlooked companies trading at unbelievable prices. The first stock is Overstock.com, ticker OSTK. Yes, Overstock is still alive and trading for just $9 and change. Most people know the name from years ago when it was a dot-com boom favorite, but what they don't realize is how it's quietly pivoted and is starting to stabilize in a tough e-commerce world. Here's what caught my attention. In the most recent quarter, Overstock surprised analysts by posting a small net profit. That's a huge shift, especially when so many mid-tier e-commerce platforms are still bleeding cash. Revenue has been choppy, some quarters up, some down, but the big story is cost discipline. Management has been restructuring, cutting waste, and focusing on profitable segments rather than chasing endless growth. Another interesting angle. Home furnishings and decor are one of the fastest growing categories in U.S. e-commerce. Think about it. More people are ordering big-ticket items like sofas, beds, and even full dining sets online. That's exactly the niche Overstock has leaned into. Add in the fact that U.S. online retail is projected to hit $1.5 trillion by 2027, and you can see why even a smaller player with brand recognition has room to surprise. Financially, Overstock trades at around 9.44, putting it squarely in the under 10 bucket. Its price-to-sales ratio is one of the lowest among e-commerce peers, meaning you're essentially paying pennies on the dollar compared to revenue. And because the company just showed profitability, that low valuation suddenly looks more like an opportunity than a red flag. What's more, Overstock has a history of pivoting fast. Over the years, it experimented with blockchain, dabbled in new ventures, and now has narrowed its focus back to what it does best: online retail. For long-term investors, that combination of brand familiarity, fresh profitability, and bargain bin pricing makes Overstock a name worth watching closely. And there's another angle worth noting. Overstock recently attracted attention for exploring partnerships to expand its marketplace reach, and it has been experimenting with new ways to improve customer experience, like integrating AI-driven product recommendations and faster shipping options. Moves like these may sound small, but in the cutthroat e-commerce world, efficiency and personalization can be the difference between survival and irrelevance. If these initiatives stick, Overstock could start to regain market share it lost years ago. But here's where it gets even more interesting. We've covered a sub-$10 play that's profitable. Now let's shift gears to something riskier, bolder, and potentially more explosive. Imagine an industry worth hundreds of billions of dollars every single year, one that almost every American household depends on, but served by a tiny online player flying under Wall Street's radar. I'm talking about the auto parts market. Americans spend over $400 billion a year keeping their cars running. Increasingly, those purchases are moving online, just like everything else. Instead of running to AutoZone or O'Reilly, millions of drivers are ordering parts directly with a few clicks. That trend isn't slowing, it's accelerating. Now, here's the twist. There's a small company that built an entire digital-first platform for auto parts. Its most recent quarter reported $151.9 million of net sales, a solid 5% increase year over year. On the surface, that sounds strong. But dig deeper, and you'll see the challenge. The same quarter showed a net loss of $12.7 million and an adjusted EBITDA of negative $3.1 million. Revenue is there, but profits are still missing, and yet this is what makes it fascinating. Despite pulling in hundreds of millions in sales, the stock trades for just 78 cents a share. Yes, under $1. That's Wall Street essentially writing the company off, while customers keep buying. This hidden penny stock is CarParts.com, ticker PRTS. It's not a startup with no business model. It's a functioning e-commerce platform with real revenue in a massive market. The risk is obvious: cash burn, lack of profits, and the chance it may need new financing. But the potential reward is equally striking. If management gets costs under control, even a small move toward break-even could send the stock doubling or tripling from these levels.